Okay, we are going to go ahead and get started. I want to welcome everyone to our Q2 update on trends and hotspots in community banking. We're very glad you're here. Thankful to have you today. Uh, my name is Tim Keith. I am one of the co-founders and currently the CEO of Optima FI. We help community banks reach their optimal state of performance. And we hope to really demonstrate today that we do that by uniquely bringing together data on macro financial performance trends, credit risk management trends, as well as growth and product ownership usage trends. And by bringing those together in a unique way, it gives you insights that you can't get in isolation in any of those individual categories. And so that will be our goal today. Brief introduction. My career or my background really has two parts. As a banker, I worked at the old AmSouth Bank. It's now part of Regions. I was in a corporate marketing role there. And at First Tennessee Bank, I was in a retail executive role, managing specifically deposit funding for that institution. The other part of my background is working with folks like yourself. So we started Optima FI 20 years ago. I've worked with hundreds of institutions over the years to analyze data and identify growth opportunities and opportunities for improvement in profitability. So, David, I'm going to hand it over to you to introduce yourself.
I've been around a while and many years in the industry and all of it in the credit risk world. I'm delighted to join with you, Tim and Dan, as we always do on this quarterly. Look forward to talking a little bit about credit.
All right. And Dan?
Hey, everybody. Dan Marks. I lead the growth business here at Optima FI. Before it, I was Chief Marketing Officer at two different regional banks, Hancock Whitney and what is now First Horizon. So um, excited to be here.
Thanks, you guys. Okay, so our agenda today will start with kind of a look at macro financial uh, performance trends using our peer performance index data for Q2 is a really interesting quarter. A lot of good things to point out and interesting things with implications for the future. We'll transition into credit risk trends and outlook from David, and then Dan will cover customer and product related trends as well. And then as we go through the presentation, feel free to submit questions through the chat. We are super excited to make you aware, if you aren't already, of our first annual client conference called Ascend. We'll be meeting in Boston in a really cool location, October 13th through 15th. We have a couple of great speakers, including Rodney Hood. Um, and more than anything, though, it is an opportunity to network with each other. There'll be panel discussions about everything from risk management to profitability management, pricing, deposits, deposit gathering, marketing, and so forth. And so, great opportunity to be with your peers in a very focused, heavy content driven uh, forum. And so, really love to have you there. In the follow-up email from this, you'll get this presentation, and there's a link in there to sign up. And you can also respond to that email or reach out to your rep, and we can get you signed up for the conference. Okay. We are going to, before we get into the content, ask a polling question. So you should see that on your screen. So please fill this out. We think this is a particularly relevant question right now with all the cross currents going on economically. So if you'll rank your key priorities for 2026, top three, bottom three, and then we'll give you a minute to do that, and we'll let the results compile and show up on the screen. So if you'll take a minute to do that, and then we'll get into our content. And by the way, if you haven't already noticed, you can slide and you need to slide the cursor up and down to see all the options.
Tim, we've got a couple, we'll give it a couple more seconds. We've got
Okay.
people still responding.
Okay, great. Thanks, Jen.
Mhm.
Okay. It looks like, okay, top three, we've got loan growth, deposit funding as the highest categories. Bottom three, cost savings, regulatory uncertainty, and maybe fee income growth. So very interesting. Um, and Jen, I believe we'll share the results of that as part of the email. Is that correct?
Yes, correct. We'll send out a follow-up email probably tomorrow with the recording, a slide deck, and then the polling results as well.
Awesome. Awesome. Thank you, Jen, and thanks for everyone for participating. Okay, so Q2 was really an awesome quarter for bank financial performance. We've been tracking data for over 20 years, about 24 years. And the Q2 really showed in a couple of key categories, record profitability, specifically return on average assets, the highest number we've seen in 24 years. So what's driving that? Net interest margin, as you would expect, is a big contributor. So NIM for Q2 broke through the 2018-2019 high to reach the highest level since 2010. NIM was up 12 basis points from first quarter and 22 basis points year over year, particularly notable given that interest rates have been static over the last year. So um, a lot of you doing a great job of really managing your cost of funds and loan yields, and we'll look at that breakout for what's driving that NIM here in just a moment. Efficiency ratio in Q2 is the lowest we've seen, again, going back 24 years in our database. When you kind of peel it apart, driven more by the revenue growth numbers we just talked about versus expense reductions, but we'll show you those numbers as well. Um, we are seeing some canaries in coal mines as we're starting to see on the margins some concerning numbers on credit performance. So David will get into that in some detail. So while we have really fundamentals that are historically strong, we do want to be ever vigilant. As you all know, we're overdue for a down credit cycle, and so we're starting to see some indicators um, that there could be some issues downstream. Again, David will talk about that. You all consume all the macroeconomic data. I don't need to read these slides to you, but I will just commentate that you have this unique combination where, okay, GDP growth declined from Q1 to Q2, and then we had actually negative employment growth numbers that we got last week for July. And so a lot of clients are thinking, okay, um, interest rates, what's going to happen? The CPI number today, down slightly from June, but still well above the Fed's benchmark numbers. And so I think before the employment numbers came out last week, most of our clients, and in fact, the Treasury yields were indicating rates were likely to go up. Even the betting markets were showing that unemployment or employment unexpectedly declining on a net basis threw a little bit of a wrench into that. And so you got really a recipe for uncertainty. You could make a good case, based on the economic numbers, metrics for a rate decrease. You could also make a good case, maybe even a slightly better case, the rate should go up. And so you got a lot of uncertainty. You add to that, you've got a new Fed chair who seems determined to let markets determine market rates. And so that just adds to what I think is the most uncertain rate environment in the 35 years that I've been in banking. So it's a lot of implications on how we look at data, and we'll talk about that as we go through here and particularly as we wrap up. So just to kind of put a picture to some of what I talked about earlier on the top, a really nice picture of return on average assets going back on the left of the graph to the end of 2002, all the way through the end of June 26. And you see that 1.17% number for the second quarter this year is the highest number on the graph. So, and just a really nice gain in the last 3 years. Down below, what's driving that? You see significant gains in net interest margin in the last 2 years from 3.26 to 3.87. You could even go back a couple of years further when they NIMs bottomed out at 303. Still not quite, almost at, but not quite above the Q2 2010 number. What's interesting to me, or part of what's interesting is, the middle of this graph really represents a historically low, or I would say artificially low interest rate environments we were in. Then you have the pandemic, and then you have interest rates returning to what I would call more normalized levels. And so to get these gains in net interest margin that we're seeing here over the last couple of years, given the environment we've had, has been encouraging, and a lot of very focused efforts on many of your parts and the industry as a whole. Kind of start digging in. We'll start with asset growth trends. So the top left graph here, you see kind of steady as she goes. So asset growth 4.5% year to date compares to 4.6% last year. So pretty static. When you look at it by asset size down here on the bottom, you see the larger institutions, 1 to 10 billion at 5.32%. And then down at the bottom, 0 to 100 million asset banks at 3.11. So a linear relationship between size institution and asset growth over in 2026. When you narrow that to just loan growth, again, as you would expect, you see a similar trend in the top left. Very, very similar number for 2026 is what we saw in 2025, kind of steady as she goes. You see more uniformity in loan growth, as you might expect when you filter out non-lending assets among the top four tiers of size, contrasted with the smallest institutions. As you'll see on the next slide, loan growth is outstripping deposit growth, which is pushing loan to deposit ratios to the highest level we've seen since 2020 at 81%. I think that's particularly relevant when we get into David's piece because loan deposit ratio is increasing. We've got some indicators of credit risk issues, and industry-wide loan loss provisions actually have declined the first half of the year. So those are kind of a red flag to be really careful and vigilant in terms of, particularly when we got record profitability in terms of that provisioning function. And so David will talk more about that. So transitioning from loan growth at 5.34% year to date, deposit growth 4.12. So again, loans growing a percentage point higher than deposits, but you do see a similar trend in terms of deposit growth being consistent with what it's been the last couple of years. You also see a similar linear relationship between size and deposit growth, with 4.9% growth in the largest tier, 1 to 10 billion of community banks, and less than 100 million at 2.83% deposit growth. So let's talk about yields a little bit. Loan yields on the top of the graph, top row, left to right. You can see an increase of 3 basis points from 25 to 26, and an increase from 24 to 25. So a little bit of positive growth, but not a lot. You also see, while community or the smallest institutions aren't growing as fast, they do show higher average loan yields at 6.77, and kind of going back the other direction at 6.22 in the highest tier. If you look at cost of funds, that's where you really see the profitability kicking in as cost of funds drop from 196 to 181 from 2025 to 2026 year to date. Really nice improvement there. And again, you see the smallest institutions aren't growing as fast, but they are growing in a more profitable way. Average cost of funds for the smallest institutions, 152 versus 202 for the largest institution. So really interesting contrast between more growth on the larger institutions, a little more profitability on the smaller institutions. So obviously, when we put these factors together, we can look at net interest margin. That's what you see here on the top. So really, really nice growth in NIM from 25 to 26, 3.67 to 3.87. Pretty significant percentage growth in that time period. When we look over here by asset size, corresponding somewhat with what we saw in the cost of funds from the previous, or net interest margin rather, from the previous slide, you see the smaller institutions holding up pretty well there. Non-interest income, basically completely flat for the last 5 years. 0.41% of average assets, slightly down from last year. Frankly, I would say, given all the pressure on fee income, regulatory and otherwise, it's probably somewhat of a victory just to tread water on non-interest income. And that's the definition of what you see on that graph. Probably not surprisingly, there's a even more pronounced relationship, linear relationship, high to low or large to small on non-interest income as a percentage of assets. Looking at efficiency ratio, at the top left, you see again really nice gains here as banks becoming more efficient over the last 2 years in particular, going from 68.5 to 61.7. Not surprisingly, the larger institutions with more economies of scale show lower efficiency ratios and more efficient, growth than the smaller institutions. And so, of course, what's driving that? We've already seen that profitability's up. When you look at the bottom here, you're looking at overhead divided by average assets, and you're seeing, kind of gradual increases in overhead expenses. And so, that profitability gains are really what's driving the efficiency ratio rather than expense reductions or improvements in expenses as a percentage of assets. So that's going to translate everything we've shown this far. It's going to translate to higher return on assets and return on equity, and that's what you see on this slide with really significant gains in ROAA over the last 2 years to the 1.17 number we showed earlier. The larger institutions doing a little better, 126 on the 1 to 10 billion, to 0.93 on the less than 100. As you would expect, a return on average equity showing a similar pattern of increase over the last 3 years. And also, we've got the larger institutions still doing a little better. Can you guys hear me? Okay, lost the sound. Okay.
Tim, I can hear you.
Okay.
Yeah.
Okay, Jen, can you hear me?
Yeah, I hear you
Okay.
fine.
Okay.
I hope it's probably just one
Okay.
person, but we'll get the
Okay.
recording to him.
Okay. Thank you. Okay. All right. And then finally, for me, before I hand it over to David, this is our performance metrics. There are a lot of things here. So I'm going to give you a flyby, but in the chat, there should be a link where you can request your personal national or state performance level report. The couple things I want to point out here. So the way this is organized is you have deciles where you've got the top decile on the right and the bottom decile on the left, and in the middle, the 50th is basically the average bank. And so I think standard deviations are useful in terms of, what's the potential for performance improvement. And so on deposit growth, where you've got a range of 15% down to negative deposit growth, that would tend to indicate that that range itself would indicate there's potential for growth. If you're fishing in a more narrow pool or more shallow pool, less opportunity to grow. Similarly, cost of deposits ranges from 1% to 2.65. So just a focus effort can move the number because there's enough elasticity there for material improvement. Also, just pointing out the range on non-performing loans, uh, pretty crazy range there. Also, looking at the average leverage ratio and risk-based ratios are interesting in terms of the trends, and David will pick up on that. So I'm going to transition over to David here and let him kind of, with that natural handoff in terms of credit risk, kind of uh, start sharing his screen and his slides.
Great. Hopefully you can see the slide. Tim, thank you very much. Trust everyone can. Um, we did, well, I started at the very top. Sorry. That's on me. Here we go. So, as a transition from some of the discussion on funding, as Tim alluded to, in terms of growth in loan to deposit, we certainly have had some tearing down from the 23 crisis of funding on wholesale funding, but as you can see there, we do have some spike ups in loans to deposits. You particularly got a significant increase in the Western. We in the credit risk pillar, we kind of regionalize some of these. I might add, just to double down on the fact that these numbers are really 10 billion and under banks. We do that largely because that's much of our wheelhouse of clientele. But we also feel like that this is more meaningful information. Um, I will say this before I get into commentary on credit. Uh, there's no question whatsoever that everything that Tim said, that so much of what's going on in the banking industry has a lot of plaudits associated with it. Some of the performance is as good as it's ever been. Um, I'm the credit guy, I'm the risk guy, and I was frankly reminded today in the local market, we had a sad situation where we had a local policeman that was arrested for leaving the scene of an accident. And my point there, it reminded me, those of us in the risk business, those of us in the credit world, we kind of do police work. And our credibility and our reputation is, I think, somewhat overburdened sometimes with trying to be accurate and to be, maintain our credibility. So, as I've told this audience on many quarters, it's not my goal here to claim the sky's falling in the least, but I do feel like it's very, very important to keep an eye on a more vigilant eye on some issues that we are beginning to sense that are merit some more concern about where credit quality may be headed. Again, credit is the big elephant in the room, almost irrespective of the general quality performance that the industry is experiencing at this particular point in time. I think everyone knows that. Uh, as Tim has already alluded to it, we've got just a multitude of factors in the macro area that are combining to create, if not concern, certainly uncertainty. And he's already touched on a good bit of where some of that has come from through the financial news recently, including a little bit of weakness in the GDP. Um, One of the things I have been really focused on, and actually wrote an article within the last month or two on the K-style economy and its impact on credit. It's particularly interesting because when you kind of bifurcate that with what we are consistently seeing as an incredibly resilient equities market, uh, and again comparing that with some of the issues that kind of come with the K-style economy, which of course is the bifurcation between more paycheck to paycheck borrowers versus the more well-heeled. I think it's still worth keeping an eye on. For example, I think I mentioned this in the last quarter webinar. The chief economist for Stifel said at a conference that I spoke to that really one of the big drivers you've got to keep in mind in the equity markets right now is AI and technology. Some of the more traditional aspects of the U.S. economy, manufacturing, certain other industries, trucking, agriculture, things like that, are not keeping up with the pace of the record highs on Wall Street. And I hasten to say, most of the credit that's being dispensed in banking doesn't necessarily have anything much to do yet with AI or in many ways technology. So I do think there is some merit in keeping an eye on that. You've heard me say this before for the last couple of years. I think the biggest single risk driver in credit quality is industry risk. So we tell our reviewers, we tell our clients to make sure you're keeping an eye on industry risk. It harkens back to the K-style economy issue to me because specifically I'm thinking about the impact on kind of the paycheck to paycheck people in terms of discretionary spending. It's potentially impacting things like tourism, restaurants, basic consumer spending generally. So I do think that's important to understand. We certainly are looking at, again, stable performance. Remember, call report data is a distinctly trailing indicator. You've heard me say this before. If you're waiting to manage your credit quality through call report information, unfortunately, those horses usually are already out of the barn. And I do think there's got to be still some focus on some of the CRE subsets, particularly in our world. We're a little concerned about multifamily. And again, the disproportionate exposure to CRE among the smaller financial institutions. Been mentioned before, but keep an eye on kind of the more private credit or the over-levered deals that could potentially create some systemic risk if we get a downdraft or a bit of frankly, a concern about credit stress generally in the economy. Specifically through our loan review work, we are keeping an eye on accelerated risk migrations within the weaker categories. But I think this is very, very important. The concern we have on credit quality in terms of banking today is not in any way focused on front-end underwriting. It's probably front-end underwriting is probably as good as it's been in my long career. The issue tends to be in what we call the post-booking servicing issues. How current our financial information, how responding our borrowers to providing banks with current financials, and frankly, the resources within the financial industry to assess and understand the risk in a post-booking perspective. Tim alluded to that. I think it was in the polling piece about the obvious change that we've incurred under the current administration on regulatory. Many bankers understandably consider that to be really a relief. In our world, we live kind of symbiotically with the regulatory community because we feel like we do things that a regulator would expect and from a risk management perspective. What I'm hearing from the regulatory community is they say, well, yes, that's true. It's up to now banks to manage better their own risk, but also their comments I've heard from two or three regulators lately, they say that also puts the burden on, frankly, trusted vendors that are providing risk management services, i.e. loan review, stress test vendors, and the like. But again, I think the burden there is to manage our own risk in the sense of being ahead of any regulatory concern. I do see, again, Tim alluded to this, but my biggest probably single concern is the potential for what could be a reserve call, so to speak, in the near future. And that is largely depicted on this graph here. As you can see, that trajectory of NPLs or non-performing loans continues to gain, and it contrasted to the decline in the reserves. Tim, I know you and I have talked, I think Dan as well. This could actually be contributing to some of the robust ROA, right, and the profitability in the industry. The reality is we're borrowing some of that from the reserves. If you believe this data here, because as NPLs continue to grow, and we've seen somewhat of plateauing, but certainly still over time a decline in the reserves to the NPLs. I think that is clearly a trajectory that can't be sustained, but so much longer. Um, the more traditional way we look at ACLs to loans, of course, uh, shows still some remarkable regional diversity. That has continued for some time now, irrespective that we're all under the same CECL uh, methodology purportedly for our reserves. There's still a big jump between what you've got the West and Southwest showing on aggregate 142 basis points of reserve, the Northeast at 100. It's interesting because as you saw on the earlier graph, the Northeast banks actually had some of the more accelerated loan growth and were, uh, you know, uh, uh, so that is of interest. There may be some disproportionate pressure on the Northeastern banks to keep an eye on reserves uh, in the near future. Texas ratio, which we haven't had to even talk about for arguably 12, 15 years, again, continues to show some upward trajectory. And of course, that's just basically a credit stress indicator uh, that we need to keep an eye on. Not a whole lot of regional differences in that. Our more traditional real estate concentration uh, views that we show each quarter. Not surprisingly, more the Sun Belt states are, in this particular case, the Southwest and the Southeast financial institutions showing higher construction and development. That tends to track with population and economic growth. But the interesting thing on the broader 300% guidance for broader CRE to risk-based capital, you've got a significantly more Northeast and West exposure for CRE. In both cases, the Midwest banks are the least exposed to CRE lending. Multifamily, again, have mentioned a couple of times before, is of a little concern to us in terms of a subset product. It's facing several headwinds from different directions. C&I tends to be kind of steady as you go. Ag, while remains struggling at some point, we're hearing spotty senses of some improvement. Um, Good uh, rains and so forth in the Midwest that are helping potentially some harvest there. But of course, naturally, the Midwest would have disproportionately larger exposure in the ag world. And I guess in conclusion, again, not to in any way be overly alarmist, there's just a much of a composite here of some news items or some concerns or trends that we do need. Consumer sentiment seems to be down. Uh, the GDP's not very robust at this point. Even PIMCO, the big, we talked a lot about the equity market. My world, I kind of look more at the bond market. That's more a form of a credit dispenser than the equity market is. Even PIMCO has acknowledged as of June that they feel like that we're now in a different credit cycle. So again, not to overstate these negative issues, but I think again it just conjures up a need to be vigilant. Um, so we will have a again, you'll have the opportunity to read the article on the K-shaped economy, and I believe later in the close of the program today, there'll be some reference made to an upcoming webinar, which we look forward to. I believe it's on the 19th of this month to kind of peel the onion a little deeper around what's real and what's not real about concern on credit quality. And at this point, I will turn it over to my dear colleague, Mr. Marks.
Hey, thanks, David. Appreciate it. Um, so the third leg of the stool here is kind of the growth drivers and really what's happening from what we see around customers and product, the intersection of customer behavior and product behavior, consumer behavior, product behavior. And really the perspective here is a very rich database. We have specific household level information on about half the US households. That database does require another feed, and so it's not it's not quite as comprehensive as the full call report universe that Tim and David talked about here ago. But the whole point is it's very comprehensive, and there's really two components of it. So the product and relational insight is drawn on a database that is specific household level, consumer and business, both sides of the balance sheet. So deposits, transactional payment products, credit products, as well as various services and digital behaviors, kind of um, uh, a household level view of how customers buy products from banks all over the country. And then the twin is the campaign database. And so because we work on behalf of clients and work with clients on a tracking basis, we have data on thousands of campaigns representing hundreds of millions of contacts, where we have what is the intersection of a specific audience, product offer, creative package, and channel mix. And so understanding what happens when we make specific messaging to customers at points in times and different points of the cycle, again, gives us, in consumer and business, gives us very specific insight on, when you do something, what happens. And so those are the two things that I'm going to talk about today from an insight perspective. Um, Building on a little bit what was talked about before, so we know that deposits are continuing to grow. Tim shared some of those peer stats, even as rates decline. One of the things that's just one of those dynamic environment factors is oil shocks. And so when we look back at history, this graph is trended information from the Federal Reserve on deposits. That's the green line. And the blue line is the year-over-year price in oil, right? And so you can see that, first of all, oil is very, very dynamic, which we all know, but we have had periods of time where there's been even dramatic shocks. 2022, we had an almost recession there, certainly a 20 or 30 point equity market decline, but there was an oil shock in 2022. It was actually much bigger than we recently experienced, and we did see deposit growth slow a little bit there. And so, that's one of the factors that we're looking at when we look at what could happen in the future. So, at least, and then, like Tim said, it wasn't that long ago we were talking about a potential rate cut this year. So if you look back as recently as March, the the odds of a rate cut as measured by the CME futures was basically non-existent, right? About as low as you can get. That's that first circle on the graph. Oil spiked up for all the reasons that we know about, and then you can see about a month on about a month lag of the oil price, those rate increases odds just went from basically nothing to almost 90% of a rate increase by year end. This is the increase by year end stat. And then as oil kind of came back down, you saw that preceding a decline. So as of this morning, they're hovering around 70% as measured by the Fed futures. The key point here is there is a lot of dynamicism in the industry, right? Where, as we talk to clients, we hear, hey, we're talking about this exact factor. And so the question is, what are consumers doing, and how should I adjust my strategy given this rapidly evolving environment? And so we're going to address some of that from the stats here, and then talk about some of the implications on strategy as we go through. Checking, of course, is the foundation of whether or not it's a household or a business's cash flow management. And so one of the things we see is with even with all the different environmental factors, there's been a slow but steady increase in the average checking balance at a household level at your average bank in the US. And one of the things that's driving that is, of course, with the return of interest, interest checking penetration has slowly ticked up a few percentage points. It stood at 28% on an even number at the end of Q2. So certainly one factor is just as consumers are thinking about where they're putting their money, that there's that factor, but also it just speaks to the overall health of the consumer. Now, we know both anecdotally and through our work with clients that some of the younger consumers, some of the secondary accounts are starting to be picked off by the fintechs, and so there is a challenge that banks are facing on the customer acquisition front, centered primarily in the younger, more digitally savvy consumers. So some of this may reflect just a seasoning of the portfolio, if you will, but undeniably there's some strength in the customer behavior around checking penetration at banks. CDs, of course, is another element where the attractiveness of CD to the consumer ebbs and flows a little bit based on the interest rate environment, other alternatives, and the economy as well. But we are seeing that we're on an upswing in CD, both on CD penetration on the left, and then also on the average balance in CD. So if you went back to right before the sort of current rate increase cycle that we're in, so in late 2023, penetration was about 3 percentage points lower for CDs, and the average balance was under $100,000. Well, the average balance has increased substantially as those consumers, and of course, in an uncertain rate environment, there's going to be some consumers that are going to be looking for the certainty of the term structure and the yield and all the things that are there. But then, if we are going to get a rate increase, then CDs are also attractive to the bank to be able to lock in a fixed funding cost into a rising rate environment. Money market, of course, is the other twin. Really accomplish or is where most of the activity is on the consumer for flexible usage of funds. And so we've seen again also an increase over time in both penetration and a little bit less average balance. We're seeing increase on money market. So when we think about our strategy, there are consumers that use one or both of these vehicles, and there's demand there. And then we talked about the macro factor. And then what's really interesting is from a response rate perspective, when rates rose in 2023, all of a sudden there was yield available to the consumer. We saw a massive spike in response rate on CD campaigns. So the long-term average we see is around 2%. That's the red line for both CD and money market. You can see that it spiked over 3x the long term in 2023, and that's been slowly coming down. And so, responding to offers and campaigns was certainly one of the things that's driving that increase in penetration and average balance at the households. And then you can see money markets are somewhat inverse to CDs from a response perspective, but they're very they're kind of converged on the long-term norm. And so when you think about funding the balance sheet and funding that loan growth, customer deposits end up being a very attractive way to do that. And it's a quick process when you have the right campaign strategy to get that in motion. We also see, not in these charts, but customer deposits tend to be a much lower cost of funds, as well as providing relationship benefits than wholesale fundings. And we do see, and so that's customer deposits. On customer loans, we're seeing steady increases on both the average household balance for direct loans as well as home equity. And so we would say, when you think about the credit environment, if you're starting to be cautious of overall credit quality, building relationships with consumers that you can generate really nice balances with that are very granular, that gives you a lot more, you know, there's the relationship benefit, but then also a high quality credit outcome. And then we still see consumer credit card households at community banks growing. Now, there's much more bifurcation in the way that this program is offered. So some community banks just don't decide they don't want to offer a credit card. We know, many times there's a partnership or a referral type relationship. There's a broad spectrum. So, don't mistake this as saying only 9% of households that bank at a community bank use a credit card, but it does say on average the community bank out there has about 9% penetration of their own credit card in the portfolio, and they generate pretty attractive balances. Obviously, when you consider the yield and the fee income benefits of a credit card, it's not it's certainly nowhere close to home equity, but it's attractive on a risk adjusted return basis. Again, we view it as more of a relationship expansion perspective. We would not advocate most community banks use credit card as an acquisition channel. And then we see in terms of response rate to campaigns, there's a little bit of a different tale of two cities. So credit unions tend to see more response to consumer loan campaigns than banks, but the average balance impact at a bank ends up being 2 or 3x a credit union, and even banks are seeing a pretty healthy response rate to loan campaigns. So this is just a touch of the insight that we have on, again, sort of the total consumer behavior, and as well as specific campaign impact and the ability to develop strategies and performance. And so if you'd wanted to dive deeper on your institution's specific opportunities and opportunities based on these benchmarking databases, we'd be delighted to talk to you about how we can rapidly do that and give you that very specific insight for your institution. My contact information is here. We can also just respond to the email that we sent out. So, Tim, back to you.
All right. Put my screen back up here. Okay, there we go. All right. Okay, so thank you all again for coming. We will do this again in November. Be very interesting to see what Q3 brings in contrast to the trends that we've just been talking about. Some final thoughts, a couple of final thoughts. One, in uncertain times, whether it's what's going to happen with interest rates or what's going to happen with the war or whatever, it's more important than ever to lean into understanding your data and the implications of your data, but doing so in a broader context where you've got that benchmark peer data that we have been talking about and showing you. So we have context for analyzing the data and then identifying opportunities in areas where there are opportunities for performance improvements. And that is what we are all about, is helping community banks do that effectively. Number two, remain vigilant in managing credit risk. Let's not get with record profitability, not take our eye off the ball there. And then number three, we have a colleague who likes to say there's never a bad time to be in the core deposit business, even if your loan deposit ratio is low. We always want to be consistently gathering and methodically gathering core deposits, and that's how we would define sustainable deposit growth. And so we obviously help clients do that as well. We have a brand new section on our website called our Insight Hub, and there's a lot of great information there, case studies and so forth, and kind of different ways that you can think about using your data and how we can help you do that. So I encourage you to go there to find out more. David talked about the upcoming coffee talk. So on
Hey,
Wednesday,
Tim,
yes.
I just want to point out, I think you're not in slideshow, so the slides
Okay.
aren't changing. We're still
Okay.
on the let's meet again in November.
Okay.
I can,
Um,
I've got it up, Jen. I can.
Yeah, if you want to stop sharing, Tim, and then
okay.
Dan can
Yeah.
just share his screen.
Okay. I am in slideshow on my computer, but whatever. Let's see. Stop sharing. Okay. Okay. Here we go. Thank you for pointing that out. Okay. So we have a couple coffee talks coming up. David talked about the one on the 19th. So that'll be David as well as David Littleton, our Director of Credit Risk Commercial and Platform Strategy. So they'll be talking about the credit environment. So great opportunity there to get a deeper dive, as David talked about. On the
Tim,
23rd,
sorry,
yeah,
Tim, sorry to. One of the things I really wanted to reemphasize about this event on the 19th, we are, so much of the, hopefully the value of this quarterly webinar is built on peer data, right? Comparisons through the public data. The credit risk pillar deals almost so much of what we deal with is non-public data. What we're going to aspire to do but on the 19th as well as going forward is help our clients and help those understand trends in non-public data. In other words, what's going on in the loan review world, what's going on in portfolios that are not necessarily call report, but it'll be done, of course, in a way that protects identities of borrowers and or institutions. But that's one of the things we're going to really begin to talk about on the 19th. So sorry to interrupt.
yeah, that's fantastic. Thank you, David. The 21st, we'll have a Cecil Q&A. We're really thrilled to have Paul back on the panel along with Steve Huntington and Sean. So should be a great opportunity to find out what's the latest on Cecil compliance that we're hearing and seeing out there. So Dan, if you'll go to the next slide. So I just want to wrap up. This is our mission statement to help you guys grow using proven data assets and technology. And that last phrase, achieve sustainable profitability growth, is really the key. So, with the unit that Dan leads, we help you identify and act on growth opportunities. David's group helps us sustain that growth through effective risk management tools and processes. And then with our call report insights data, we help you understand and manage and optimize profitability. And so as we go to the next slide, Dan, that kind of translates to our three pillars of the way we're organized. So we have Optima FI growth, which helps you specifically acquire, onboard, and cross-sell customers. David manages Optima FI credit risk, which does your third-party loan review, provides a credit monitoring software that is easy to use and affordable, does portfolio level stress testing as well as CECL compliance. And then our balance sheet pillar includes the CD Marketplace, which is a great liquidity tool for plugging liquidity needs, call report insights, which we went through in some detail earlier in terms of the financial benchmark financial trends in the industry, and then a brand new product called Household Insights that some of the data that Dan showed would be in there, really benchmarking your product ownership and funding levels to your peers to understand how your macro financial reporting data is driven by the relationships you have with your customers. So if we go to the next slide, Dan, thank you all for coming. Just a reminder, we will send a follow-up email probably tomorrow that will include this presentation, a recording of the presentation, as well as the poll results. So be on the lookout for that. And let us know if you are interested in attending the Ascend conference or interested in getting your opportunity assessment. And then if you haven't already through the chat, also if you're interested in your performance report, state or national, let us know. Thanks again, and we will see you all in November.
See everybody.